asset. So we're going to increase our assets, right? When we purchase supplies on account, are we using cash or is it an accounts payable? Accounts payable. What happens to our accounts payable? They go up. We're purchasing supplies on account. They're going to go up. Well, I don't know how I can do it without it thinking it's an equation. There. So our liabilities here, when we purchase on account, they go up. So our supplies are going up and our liabilities are going up. Let's look at the next one. Received cash for providing a service. What happens when we receive cash? Our cash is going up. So our cash is going up. Our cash is going up. But what does it mean we provide a service? Our revenues go up. Our revenues increase our stockholders' equity section, don't they? So our stockholders' equity section is going up. So our stockholders' equity section goes up. Make sense? Let's look at the next one. Expenses paid in cash. If we use cash to pay an expense, what happens to our cash? The cash goes down. But what happens? Is it a liability? What's an expense? It's a part of stockholders' equity. What's going to happen to stockholders' equity with an added expense? It goes down because we don't have as much anymore, do we? So that's going to go down also. Do you see that what we do on one side, we're doing on another side? Okay, now let's just take this. We're going to just expand. I mean, I probably went a little too far on that PowerPoint. We're just going to keep expanding, okay? So, the next problem. We've got B3. Using the following tabular analysis, show the effect of each transaction on the accounting equation. Put explanations for changes to stockholders' equity in the right-hand margin. For retained earnings, use a separate column for revenues, expenses, and dividends if necessary. Use illustration 3.3, page 110 as a model. Let me see what 110 is. See what we're doing here? We're basically showing up, down, okay? Just like we had in the problem. So, basically, 138. We've got these various assets, and we've got a couple liabilities and stockholders' equity. So basically, I'm going to take this section, and what I'm going to do now is part of this asset section, my asset section is going to have 3 accounts. What is one? Cash, accounts receivable and supplies, okay? My liabilities section is going to have what? It's going to have accounts payable. What else?
Notes payable.
And what else?
Unearned service revenue.
Okay? Then our stockholders' equity section is going to have what? Common stock and retained earnings. Okay? And then part of the retained earnings is going to be, let me see how to do this. Part of the retained earnings is going to be revenues. I'll bring it down here. Expenses, right?
Dividends.
And dividends. So our assets are here. Our liabilities are here. Our stockholders' equity section is here. What I'm trying to do is highlight them so we know which accounts follow what. Okay? Okay. So we're going to do the same thing here, guys. We're going to basically create transactions and figure out where they go. Okay, are we okay there? So, we go back here and it says, okay, so we have this in here, common stock. During 2014, Comstock Company entered into the following transactions. I'm really confused. I don't see. Was this piece for?
That piece was for
The prior
the
problem.
LB,
Okay,
three.
shoot. Okay. So this one, we might have to change some up. For each of the following accounts, indicate the effect of a debit or a credit on the account and the normal balance. So when we debit an accounts payable is what kind of asset? Accounts payable.
It's a liability.
It's a liability. Liabilities, for them to increase, what do we do to them? look at your cheat sheet.
Them to increase?
For a liability to increase, we do what to it? We credit them. So if we debit them, what is going to happen to the liability?
Gonna go down.
It's going to go down. What happens when we have accounts receivable? Let's look at accounts receivable. Yes?
Are we on 3-4 or 3-3?
I'm wrong. That's why, okay. We need to be on 3-3.
Well, for 3-3,
Craig?
you have it set up right. It's
That's
just,
the, yeah.
Okay. But not really, because,
no, it's the same setup.
well, you'll see why. Okay, so 3-3. I'm sorry, guys.
If you want to do 3-2, the problem's just on the previous page. You have it set up right.
Okay, so we didn't start with 3-2? We did
You wanted to
3-1?
start with 3-2.
Okay, so,
So just the questions are at the bottom of page 137.
but we already did that one. Or did we do
No,
one?
we did 3-1.
God, I am, okay. Whew, I had a tough night last night. Okay.
Mine's getting me, I swear.
So, borrowed, Craig, thank you. I'm sorry. Borrowed 60,000 by issuing bonds. So we borrowed 60,000 by the guise of bonds. What happens when we issue bonds? Think about it. If we go to the bank and take out a loan, what do we get? Money. But we also increase our liability, don't we? Bonds are the same way. When we issue bonds, what do we receive? Money. What happens to our bonds payable?
Credit?
They increase, don't they? They increase. We need to pay that money back. So when we issue bonds, borrowed 60,000 by issuing bonds, our cash is going to go up, won't it? And what happens to our bonds? Our bonds payable goes up. Gosh. Okay? So the first problem is A. Our cash goes up and our bonds payables go up. We paid 9,000 cash dividends to stockholders. What happens when we pay dividends to our cash? Cash goes down. What happens to dividends?
Debit?
Go down.
Down?
They go down, don't they? So our dividends go down also. Next one. We received 13,000 cash from a previously billed customer for services performed. We already billed the customer. Now we're just getting the money. So what happens to our cash when we receive the money?
Up?
Goes up. What happens to our accounts receivable?
Goes down?
Our accounts receivable go down. Aaron, why do they go down? You're right.
Well, they're both assets, to equal out.
So basically, we showed on our books we were going to get some money, accounts receivable.
And you finally get the money.
We finally get the money, so they don't owe us anymore, do they? And so our accounts receivable is going down. Now look what's happening here. Our cash goes up, our accounts receivable goes down. Is our equation still in balance? Assets equal liabilities plus owner's equity? It is. One asset went up, one asset went down. It's still in balance. The next one.